Yeah, I mean, at Templeton, we typically look at normalized earnings. So the company makes 12% margins at the peak of a cycle, 8% at the foot of a cycle. We normalize on a 5-year typically forecast at 10%. We're not trying to predict earnings. Forecasting is a mug's game, but what we're trying to understand is the normalized earnings power of a business. So what should this company earn through a cycle in terms of earnings and cash flow, and what are we paying for that? And we're typically looking to pay maybe mid to high single-digit multiple of normalized earnings on a 5-year view. The reason being, we're typically looking to double our money on a 5-year view. So we're looking to buy it at 50 cents when we will leave it to worth $1. So that's first and foremost how we would approach things, at Templeton, is a normalized earnings or cash flow. But there are other ways of looking at it. If you look at a bank, typically you might want to look at what's its normalized return on equity. And therefore, what's the price to book you would pay for that? And are we getting a big discount to what we believe that to be? Again, on a 5-year view, if the normalized return on equity is 12%, maybe not 20% of yesteryears, and we're paying 0.7 times book value for it today, that gives us the opportunity to double our money on a 5-year view. With something like a mining company, you could do the normalized earnings approach, definitely. We typically look at some level of resource-based measure, some type of NAV. Now, there's lots of circularity in that. I tend to hate DCFs because garbage in, garbage out. And with NAV calculations, typically you're getting some of that type of garbage in, garbage out. But you can have a look at the resource base. You can have an understanding of what it costs to produce them. You can put a long-term metals price in there, and you can get some understanding of what the NAV, realistic NAV of the company is, and again, what price we're paying for that. And something like a Stillwater, again, trading down roughly about 50-60% of what we believe to be a realistic NAV based on our longer-term assumptions.